Thank you very much. I would like to add why I have been invited. I was responsible for corporate governance for 3 large German companies, Siemens, Infineon, and more than 12 years Munich Re, and I was in charge of corporate governance there. But since 2019, I'm a free man, a lawyer, so I can speak up my own mind. I'm not a lobbyist anymore, and that's what I will do. You will all know what you see here, so you think now he talks about art, not climate change, but art, which is of course more interesting. But what you see here is something, you see a family, the royal family, the Infanta Margarita in Las Meninas, and you see her parents in the back in the mirror, and you see some of the people around them and some of the employees. And when you look into a family, and especially families which have been there for a long time, you see this is an expression of loyalty. There is nowhere more loyalty than in a family. Sometimes you are cross with each other, sometimes you hurt each other, but you are in it until you die. So it's very sustainable to be in a family. And royal families also refer to themselves as the firm, as the British royal family. And you see some of their employees. You see 2 Velasquez, actually. One is the painter on the left, and another one is the marshal in the door, and that are employees of the firm. So we will see how this goes on. Loyalty shares, I have some sections. What are loyalty shares? The history, goals, arguments for and against their introduction, and you have recently introduced them in Spain in May last year. There are academic papers and academic efforts, which is always good for a lawyer because real academics don't consider us academics. We have a discussion of arguments and then results and proposals. So what are loyalty shares? That are shares that grant certain additional rights over normal shares, such as additional voting rights, which is normally the case, or additional dividend payments, 10% over normal dividends, to shareholders which hold them for a specified period of time, normally 2 years, sometimes 1 year, sometimes more. And those special rights are lost when the shares are transferred. So when you hold shares in a company for 2 years, you get additional voting rights, but when you sell the shares, the voting rights are lost. And the buyer starts a new holding period. They are not multiple voting rights shares or preferential shares, instruments you will find in other companies a lot, especially multiple voting rights shares. The American capital markets are very successful in marketing their business model of 1 share, 1 vote, but what they will not tell you is that a lot of American companies have different voting share structures, especially there are large American companies with shares with multiple voting rights or dual voting rights, which are enshrined in the share, and when you sell the share, they remain. So that there is a difference. The history. In Spain, it's fairly new, but it started in France in 1933. And it was last changed in 2014. And in France, it's now the default option for listed companies. And you have to opt out of those loyalty shares with a 2/3 majority. This is important because, as you know, if you want to introduce something and you need a 2/3 majority, that may be difficult, especially if you have institutional investors against you. But if you want to opt out, it's easier to defend. As always, when you play a match in football, it's easier to defend, like Atletico Madrid. They are very good in defending. But if you want to attack, like Real Madrid, you need more efforts. In Italy, it was introduced in 2010. There was a change in 2014, so we have some evidence on Italy. We'll come to that later. In the Netherlands, there was always freedom in the Articles of Association, and you have some companies actually coming from Italy to the Netherlands arguing, oh, it's nicer here. There's not as much sun and the food is not as good as it is in Italy, but they have double voting rights. So we move like Fiat and Ferrari. Belgium, it was introduced in 2019, but there you have the opt-in mechanism. USA Delaware allows for that, and Spain introduction in 2010. So what are the goals? To combat short-termism. That's what you said. Management taking measures that increase short-term performance at the cost of long-term value. That is short-termism. For instance, if you cut R&D investments to boost your quarter earnings, and that means you face negative consequences in the long run. What are the key drivers? There are two different theories. One is shareholders' preferences, and they pressure management to do that. The other theory is, it's a misalignment of manager and shareholders, and it's an agency problem. Management prefers short-termism and short-term profits, mainly for bonuses, and shareholders prefer long-term focus. So there is, as you see, two opposing theories on this, and we will see what is right. So the goals of loyalty shares, it's nudging longer investment durations by adding benefits. So you play with market instruments. Double voting rights, but who cares? Some investors actually do. Long-term key investors, normally family investments or state investments like in France. Family offices, having been invested over decades. I'm the executor of a will of an old German Jewish lady who had shares in Munich Re. And I investigated how long they had the shares in Munich Re, and I came back to 1880 when Munich Re was actually founded. And that family has held the shares in Munich Re during all that time. So that shows you sustainable corporate investment. And all those instruments may be important, especially when you realize as a family you cannot shoulder the capital requirements of a company anymore. You have to go public, but at the same time you'd like to be invested. So loyalty shares may be a mean to do this. And dividend bonus, all investors love dividend surpluses. In France you have this attendance fee in general meetings for quite some time, which was successful. But if you get 10% more for being invested for 2 years or more, then that's even better. So what are the differences over multiple voting rights shares? As I've said, those shares are normal shares and they morph into loyalty shares or they lose that status. And there is no market price for loyalty shares as it is for multiple voting rights shares. So it's different from them. And they are always transferable. So what are the arguments for loyalty shares? They combat short-termism and foster sustainable investment in a sustainability culture. Because if you know you have key shareholders or a majority of shareholders with double voting rights for the long run, you can rely on them. They reward long-term investments, and that is important because it's earning a profit with dividends with holding the share, not by selling it. And that's the key difference to other fund managers which make profits by constantly buying and selling shares. And it's a good mean to cater or to respond to specific company situations. When you go public or you need something, let's take the case of Renault in France, where they have this. The state wanted to keep a strategic minority holding and thought that there would be other investments which want to break up Renault. And they said, no, we want to keep it like that, so we cater for this. And the academic theory or economic theory would suggest there is always a fair price for that share. So you know if there are investors holding it for 2 years, they have double voting rights, so markets would know this and they would take this into account. And all shareholders can benefit from long-term holdings. There is no difference between multiple voting rights shares and others, so it's open for all shareholders. And then there is the argument of a defense against hostile takeovers. I'm not convinced there, but we will see. Arguments against, and it's done by BlackRock. You all know BlackRock. BlackRock is now the black elephant in the room of every company because they own between 2 and 7% of all shares of all big companies all over the world. And their CEO, Larry Fink, writes letters to management every year, and when it arrives, the management reads it carefully. And they have issued a paper of 4 pages, and they have arguments against this. I will tell them. Because they are so heavy, they just drop down on companies. We have to take them seriously. They say research suggests that enhancing voting rights do not change time horizon of the company. That's a good one. The second one is double voting rights require registration as shareholders, and registration is complex, often easier for domestic investors. That is true, but it's not the fault of the companies. We will come to this. Institutional investors tend to divest from such companies, leading to lower share prices. That was a surprise to me when I read this, and I'm not convinced. And their institutional investors are not short-term, they claim, and not incentivized to turn portfolios. That was even a bigger surprise for me, because there is much evidence to the contrary. They say that differentiate voting rights incentivize controlling shareholders to sell stake to a potential acquirer. That seems to conflict with the case of losing double voting rights when selling. And dual class shares may be tolerable for nascent companies, but not after some years of going public. That's what they claim. What they did not tell in this paper is the real argument why they are against this. We will come to it. There is some academic work, and surprised there's no unilateral views and results. So I don't know how much time you have already spent on your studies, but that is something you will learn at the very beginning. There are always 2 or more views. If you have 2 lawyers, there are at least 3 views. But even in the real academic worlds, there are 2 views. So that's not a surprise. Some studies claim it decreases company value, and some studies claim it increases company value. Oh dear, that's good. As a lobbyist, you think, that's brilliant. I'll take one side and argue against the other. And there are several papers on multiple voting rights shares from the US from 2000 to 2021, and some on France and Italy, which are different. So there are US papers, as said, multiple voting rights shares, and I will take out one, Roe Venezia 2021, so it's fairly new, and they have some arguments. And now this is a good one, and I really ask you to cherish it. So it will facilitate insider control. Loyalty shares will facilitate insider control. That's the dominant motive, they claim. And they will undermine long-term planning. Oh, that's interesting, because you thought it will help long-term planning. They boost shifting voting power to corporate insiders. That's what they claim. And we should expect loyalty shares to empower conflicted corporate players. That's very strong words. To seek, not focus on long term, but to protect themselves, and they control their insiders. And they say existing data from Europe, where loyalty shares are more extensively used, support this structural analysis. So when you read this, you think, oh, this, they say black is white and white is black, must be lawyers, and that is true. One is a professor at Harvard. Harvard places more than 20 billion in equity, and they do heavy trading, and they focus on short-term profits, so that's understandable. The other is working for Cleary Gottlieb. It's a law firm working for big investment funds and intermediaries, so that may have helped their position. So there are scientific papers, real scientific papers, and that is something, I don't know how many of you study economics and not law, but for a lawyer this formula is not understandable, but it looks like science. It's really brilliant, isn't it? And it comes long-term consideration. So earnings management were not just managed quarterly, but they were the earnings management decreased, and the perspective changed to long term. So that is good. They have a caveat, further research may be helpful. We have the same paper in France, 2019. They used a different approach. They used the approach of the Loi Florange 2014, but what happened after this introduction. They had also real data, 288 firms with double voting rights, 145 not using them. 62% of the big French companies have it. The smaller companies tend to use more often than larger, and the analysis is the relationship of loyalty shares and firm value. They analyze it before or not the decision to adopt or not loyalty shares. So they found out. The market reaction to the announcement not to adopt loyalty shares was negative. There was a more negative return over the median return for not adopting loyalty shares. And the market reaction to adopt loyalty shares was positive, a better return when you adopted loyalty shares than not. And overall, the effect of adopting loyalty shares from firm value was between 1.2 and 1.5% increase in firm value. So, also further research. So let's have a look at the arguments for. It combats short-termism and market perception supports that view. It rewards long-term investment, that's also true. And it's mainly used for family companies or going public or state holdings, that's also what evidence supports. There is a fair price for this if markets are informed and trade on full information, and all shareholders can benefit from this, so that is true. But it's not a hostile against takeover. It's not a defense against hostile takeovers. That's nonsense, because if you want to sell a share, you sell it if the price is right. Let's look at BlackRock's arguments. They say research suggests that enhancing voting rights does not change the time horizon. And my question is, which research? Because they have multiple voting rights, which is different, and we have seen the two papers which say the other thing. It's more complex for domestic investors due to registration. That actually is true, but it's not the problem of companies, it's the problem of intermediaries. When you have registration cross-border, intermediaries actually impede registration, and they tell investors, oh, it's too complex, it's a company law problem, but it's their outdated IT systems which do not cater for this. But that should change with the EU regulation 2018-12 with all the information which has to be provided for that. Lower share prices from institutional investors. There is no empirical evidence for this. Index funds copy the index, and managed funds base their investment decision on performance and expected performance and not on loyalty shares or not. And the argument is made for controlled companies. So we had the other one, short-term and not incentivized to turn portfolios. That is plain wrong. When you analyze compensation structures of actively managed funds, you see they are incentivized on annual performance. And annual performance either means return on what they had over the year, or it means their ranking in the fund industry. And they get the bonus ranked on 1 year performance in the fund industry. So it's wrong to claim they are judged on long-term performance. And, sorry, the second one, we did some research in Munich Re, how many times institutional investors turned their portfolio. And we found out that none of them held the portfolio for more than 3 years. None of them in actively managed funds, which were not index funds. So they are not long-term. The controlling shareholder is not for loyalty shares, that's also wrong. And the dual class share structure, we will have to see. The argument which is not in here is all those asset managers make most money with lending out shares. They will tell, we have it in our funds, but it's dead for them. So until they get a dividend, it's dead. And what they do is they lend out shares, and they get between 20 and 50 base points for everything they lend out. So that is how they make money. But loyalty shares, you have to hold them for 2 years. If you lend them out, you can't make that money. And the next problem is, if you lend out shares, where and why are they used? They are mainly used for short selling. So they are lent out to someone, and they sell the shares, they drive down the share price. So you see that is actually against long-term investment, that is against sustainability. But that is what they will not tell you, because they don't tell their investors that they make their money. So that is the real reason they are against loyalty shares. So what do we do? We see loyalty shares combat short-termism, increase company value. They are a good solution for a situation which is going public, for instance. And there are other problems with that, the disenfranchisement of investors and funds and the management, which there is no link between. Investors have no say in investments, and paid managers have no skin in the game. So that is the problem, short-termism and long-termism. Voting rights are also very often not used by fund managers. They just don't vote, especially cross-border if there's no obligation. And I personally think with the evidence you should try and prove whether it's right or it's wrong, especially in Spain after you have it new. So that's the second painting. That is a bit younger. It still shows a family, hopefully a successful family, in much more light, the modern light of Sorolla. So you are blessed in Spain not only with loyalty shares now, but also with brilliant painters. And so my wish is you should try it. Try loyalty shares and try what it yields as results. Thank you very much.
Thank you.
Sorry, 20 minutes.